Hello. Hello. Can you all please confirm if I'm audible and visible? Perfect. So, hello everyone. Hope you all are doing well. I am Divesh Harpalani and welcome to my YouTube channel and this video. This is the first lecture of this new batch for ACCA Financial Management Skill Level for March 26 exams. For those of you who've already watched my orientation video, probably know about me. But for those who have not, and for those who I am new, just a brief introduction before we get started. So I am a chartered accountant by qualification, fortunate to have cleared CA with an All India rank 6 in CA Inter and with an All India rank 13 in CA Final. I've done my articleship at Deloitte, and I have close to 5 years of work experience across private equity at Advent, which is one of the top 10 global private equity funds. And it is in fact at Advent, which is the private equity world, that I have practically lived all the financial concepts that we study. I have also worked at Bain & Co, which is one of the top three global management consulting firms. I am an international public speaker and had the fortune to represent ICAI, which is the Institute of Chartered Accountants of India, at the Sri Lanka CA Student Conference. I have mentored close to 1,000 both students as well as freshly qualified individuals. And of course, I have the fortune to be in front of you as your faculty for ACCA Financial Management. Just brief overview about the course, and before we delve into the details of the course, of course, there's a target that we want to achieve today in terms of the content that we'll be discussing. But before that, I just want to give you a brief overview about the financial management, which is the F9 skill level course, as well as some details about this batch, which is with the BP Virtuals Global Batch. So the financial management course practically enables you to develop a structured thinking such that you, as a future CFO, as a future investment banker, are able to make real life decisions. You have to, throughout the course of this batch or this subject, you have to assume of yourself to be a CFO of the multi-billion dollar company. And you have to practically make real life decisions as we study together. Just a brief overview about the course. The course is divided into five or six broad sections, and I'm not going into the details of the full course, but at the highest level, section A and B are a bit of theory, which talk about the role of you, which is a future financial manager or an advisor or a future CFO of a company. What are the objectives of a CFO? The objective of a CFO or you in the chair of a CFO or a financial manager is not to make profit, but it is to make decisions that will end up making profits. At the end of the day, a CFO or a financial manager has three objectives to achieve or three decisions to make. Now, leave aside you as a CFO. Think of yourself as a student or as an individual. If you were to talk about decisions that you would make around money, what are the typical decisions that you'd make? There's first point that you'll ask yourself as to how do I make money? Where do I earn money from? That is a typical decision which even a CFO will make for the company, which is the sources of finance. Point number two, once you've earned money, where do you invest that money? Let's assume you've earned crores of rupees. You're probably the next Elon Musk. Where do you invest that money? The question, of course, is whether you open a multi-billion dollar startup or work towards the next business idea or probably buy the next Mercedes for yourself or probably buy a mansion. The choice lies with you. This decision is nothing but an investment decision. The same choice is what a CFO will make within the company between the different options available for investments. What is the investment that you end up making? And number three, once you've earned money and you are earning, once you've earned money and you are earning, let's say, returns from that investment, right? Where do you use that returns? Whether do you spend that returns or do you reinvest that money? This is the decision again that a CFO will be making. Again, a decision which is the dividend decision, which is what do you do with the money that you've already earned? So at the highest level, the objectives of a CFO is the shareholder wealth maximization. And all these three decisions are to be taken to achieve maximization of shareholder wealth. So section A and B essentially talk about financial management as a function and environment in which the business operates. So there's a financial environment, of course, there's government, there's RBI, there is money markets, and a business is exposed to the entire environment that it operates within. So the next section is around theory about financial management environment. The third one is around working capital, and working capital is nothing but the bloodline of business. The money that is needed on a day to day basis to run the business. What is profit? Profit is the barometer of success of a business, yes. But can a business exist without cash? The answer is an absolute no. And hence, cash management and working capital management is absolutely important. Section number 4, and this is one of the most important sections, both from an exam perspective as well as the real life perspective, around the decision that you would want to end up making in your life, which is how do you appraise investments? How do you make investments? Which investment to make, which investment to not make is what this section deals with. And today, investment appraisal is effectively what we will be discussing as the topic. Section E is about business finance, which is nothing but sources of finance. Marketing guy would say, we need to sell more, we need to advertise more. An HR guy would say, let us hire more. And the CFO will ask this question, where do we get money from? With whose money do we do all of these things? So with whose money is essentially what the sources of finance tells you about. Business valuations, thanks to Shark Tank, most of you now understand the world of valuations and startups. But it's not just startups that get value. Each and every business has a valuation. Each and every business has a valuation. So this concept of business valuations is what we will be studying in this section. Last but not the least, risk management, which is any business operates in a world full of risks. But the purpose of the CFO is to make sure that despite these risks, the business runs and continues to earn money. So that is nothing but in risk management. This is where the CFO assumes the role of an insurance agent. Investment appraisal is where the CFO assumes the role of a fortune teller, where he will actually decide or say whether the investment will make money or not. And risk management is where he will assume the role of an insurance agent, where he says whether the risk is worth taking, how to hedge against those risks. And finally, employability and technology skills, which is a bit more of theory. I'm not going into the examination structure right now. I have a separate orientation video which is recorded and is posted on my channel. You can go through that to understand the examination structure. But just briefly before we go ahead into the content for the day, the details of this batch. The batch starts today. Yesterday, we had an orientation video which is posted on the YouTube channel, like I mentioned. The batch will be Monday to Friday, every day, 7 to 10 p.m. Of course, we started at 7 p.m. today. The batch will be both live and recorded. The first three demo lectures will be uploaded on YouTube. The duration of the batch will be around 70 to 80 hours, and the batch will complete sufficiently in time ahead of your March 2026 exam. So we will be completing the batch in mid of February. There will be enough and more mocks that will be taken because it is important to practice, and without practice, your conceptual knowledge will not help because eventually you need to end up passing. So there will be 2-3 block-wise tests and 2 full-fledged mock tests as well, the solution of which we will be discussing live in the class. Finally, doubt solving. A lot of students will ask, sir, will you help us solve doubts? Will you be available? Absolutely. You have my WhatsApp number, which is given in the description of this video. You can take my WhatsApp number and send queries. There'll also be dedicated live query solving. So if you've already not enrolled for the batch, the details of the batch are also given in the description. You can visit DB Virtual's global website and can enroll for the batch. But jumping on to the content for today, chapter number 2, which is basic investment appraisal techniques. Before we go into the details, the notes, etc., at the highest level, think of basic investment appraisal techniques as, and on a very lighter note, just the way you use dating apps like Bumble, where you swipe left or swipe right, deciding on whether the person is worth dating or not, right? You evaluate that person from a dating perspective. Similarly, of course, not the exact same analogy, but on a slightly similar note, you will be ending up analyzing a particular investment, whether that is worth making or not from a business perspective. You remember, you as a CFO, you have to keep wearing that hat of a CFO. And as that CFO, you will have to evaluate whether an investment is worth making or not. Will it give you enough returns that you need for your business to succeed and your shareholders to earn enough wealth? Think of it as if you're going to buy a car, whether you want to buy a Honda City or whether you want to buy an i10 or any other car out there. What will you do? You will understand what is the total amount of money that I have to pay on day one. What is the mileage that this car will give me? What is the life of this car? What are the amenities I am getting? How far can this car run for me? What is the capacity of this car? And eventually, after evaluating all of this, you will decide whether you want to invest in that car or not. Again, similarly, the CFO in the real world will decide whether a particular project is worth undertaking or not on the basis of this particular evaluation of an investment. So, at the highest level, investment appraisal is nothing but evaluating investments from a business perspective and deciding whether the investment is worth undertaking or not from a profitability perspective. And before you go into the specific content, I will run you through the entire content and we'll discuss each of these concepts one by one. I just want you to take an overview of these notes that I have prepared. And of course, such similar notes are prepared for all the other chapters and absolutely conceptual surrounding all conceptual understanding, exam oriented, all concepts are there. There's at the same time, there is enough summaries to make sure that you are able to revise ahead of the exams and well in time. So at the highest level, there are a lot of these boxes that we've given such that you can, such that there are notes and exam tips that you can use while solving sums. There are common mistakes that a lot of students make, and hence there are a lot of these exam tips that are given across these notes so that you as a student, when you study from these books, you ensure you don't end up making those mistakes. There are a lot of examples all through the notes. I'll give an example. There's an example one, example two, and so on and so forth after each concept so that you can understand the concept and right after that you can evaluate the example for yourself. The solutions of these examples will be given towards the end so that you try these examples and questions for yourself and only then you look at the answer. So you solve all the practice questions and only then you look at the answers. And like I mentioned, you have exam tip. So just taking you through the overview of these notes. There are examples. There are of course pointed bullets for each of these concepts, so you can read and you can retain. All the headings are also written here in bold so that in exam you remember what the 5 headings were when a particular question is asked. There are such tables as well which are given, which are a good summary of a particular point and the explanation around those. Like I said, exam tip again over here, what to ignore, what not to ignore when a sum is there in exam. There are examples as well which are given. There's a decision framework. What if the answer is yes? What happens when the answer is no? And finally, there are these key notes as well. How to solve a particular sum. What are the key things that you'll have to remember while solving the sum? But the highlight is yet to come. Of course, like I mentioned, there are these practice questions as well. The highlight is this. So there are these chapter summary and exam tips, which is at the end of each chapter, there'll be summary of all the concepts that would have been discussed in that particular chapter. And you can just go through this in the last couple of hours before the exam and read through all the points and the final checklist for you to master a particular chapter and concepts. My aim from this batch and my classes is to make sure that not just students clear, of course, the passing marks are 50, and I want that all the students who take my batch clear, but not just that, everyone should thrive and not just get stuck at 50 marks. Everyone should clear with flying colors. So that's the batch. With that, let's just get started with today's topic. So, like I said, today's topic is basic investment appraisal techniques. There are basic investment appraisal techniques, and in chapter 3 to follow, which we will be discussing, there are also advanced investment appraisal techniques which take into account the use of time value of money. What is time value of money? The details of that I will come to later. By the way, By taking his batch, I am going to assume that you do not know anything absolutely about financial management. I will start teaching financial management from scratch and ensure that by the end of this batch, you would have mastered financial management. Coming to investment appraisal process. Investment appraisal is effectively nothing but it is a critical stage in the capital budgeting process. Capital budgeting process, as in when the decisions are being made, when the budgets are being prepared on where to use money of the business. At that point in time, an investment appraisal process is made. By who? By you as the future CFO, who evaluates the expected returns from an investment. Any investment is, of course, made to earn returns. To evaluate the expected returns versus the expected expenditure levels, which is nothing but the investment that you will be making. And this, while doing this, we also assess all the future costs that you'll have to spend to earn a particular amount of money and the benefits that you'll get over a project life. Now, let's assume you as a student dream, okay, I guess these cafes earn a lot of money, right? As I grow up, probably at some point, I want to open a cafe. At that point in time, opening a cafe, actually, you'll realize is not just about buying those coffee machines. But when you invest, let's say 10 lakhs or 20 lakh worth of rupees, you will realize how to earn that money over a period of 10 years. At what period of time will you get back your 10 lakh rupees? What is the annual profitability that you will get? What is the expected returns versus the 10 lakh rupees that you would have invested? The future costs, every year you will incur a particular cost to run the cafe. You will evaluate all the future costs and the benefits when people come to your cafe. That is the process of investment appraisals. And what is investment? So, capital investment is defined as spending on non current assets. Vishal sir would have taught you in FR that non current assets are those that have a life beyond 1 year, that are here to stay for your business, and it forms part of the capital budget. In this chapter, we will evaluate primarily two techniques and both easy ones. One is return on capital employed, which is also called the accounting rate of return, and the second one being payback period method. Let's really jump to the first one because when we discuss, you'll realize what this is about. Return of capital employed, which is also called accounting rate of return, measures the average annual profit relative to the capital investment. At the simplest level, think of it as the car that you are going to buy. The car that I had given an example of, assume a 10 lakh rupee car that you're going to buy. What is the annual amount of, let's say, cab fare that you will end up saving? That annual number, that average annual number relative to the 10 lakh rupees that you have investment is nothing but return on the capital that you are employing. And this capital is nothing but the 10 lakh rupees that you'll be investing on day one. So there are two ways to calculate this return on capital employed. One is the initial investment basis, which is, let's say, on an average, you will be saving about 1 lakh of cap costs. So what is 1 lakh divided by 10 lakh, which is the initial capital cost that you would have invested, and hence your ROCE will be nothing but 10%. But remember that these annual profits have to be before interest and tax. And why does it have to be before interest and tax? Because when you invest, you can invest in both ways. You can also invest your own money. You can borrow money from someone and you can invest in a particular investment. If you want to, let's say, invest in a mutual fund. Of course, one way is you use your own money and invest in mutual funds, or you borrow money from your friend and you put the money over here. So the profit that you will make, irrespective of who has given you those funds, irrespective of the sources of finance, if you remember, I mentioned that the CFO will ask the question, who gives that money? Irrespective of the source of finance, the profit that you are making, that is without considering the interest and tax, everyone has to pay in the country. Everyone has to pay. Now, I'm sure you will be saying, sir, I don't think my dad pays tax. Sir, he runs a business. It's easier for him to not pay tax. All those anomalies aside, assume everyone has to pay tax, and hence, keeping aside the tax, keeping aside the interest, what is the average annual profit that a particular investment will be making. Think of it as you, as the CFO, have a choice to invest whether in project A or in project B. This choice will not be determined by what is the tax that you're paying, because you have to pay the tax in both the cases. What is the investment with between project A and project B that you'll be making, that will determine whether you should invest or not. Now, the second formula is based on, or the second method is based on the average investment basis. What is average investment basis? Now, think of it as when you bought that car and you want to drive that car for, let's say, 5 years, and after the end of 5 years, you'll be getting back, let's say, 4 lakh rupees from that car, right? When you sell the car in second hand, you'll be getting 4 lakh rupees. Now, is the capital invested 10 lakh rupees that you spent on day one, or is the capital invested the average of the amount that you will be using through the life? What will you be using? You will be using an average of 7 lakhs through the life, which is nothing but 10 plus 4, 14 divided by 2. So your return is not on the 10 lakh that you've invested, out of which you're going to get back the 4 lakh rupees. Your return is actually on the 7 lakh that you're using on an average through that particular life of the car. Today, the value of the car is 10 lakh. 5 year hence, the value of the car is 4 lakh. On an average, the value of the car is 7 lakh. And on that 7 lakh, you will be saving 1 lakh rupees of cap costs every year. So 1 lakh rupees by 7 lakh rupees, which is about 14%, is what you will be ending up making. So, which is why the second method is much better and more logical than the first method. Now, the obvious question will be, what do you do when you have a question in exam and nothing is mentioned? If nothing is mentioned, you use initial capital cost. If nothing is mentioned in the exam, you use the initial capital cost method, which is this. And most likely the institute will actually ask you the average investment basis, which is the second method. So this is actually exam favorite, not the first one. But if nothing is mentioned in the question, you go with the first question. So over here, the ROCE formula is nothing but average annual profit. In our example, the profit was the amount that you are saving by driving that car, which is 1 lakh rupees every year. And the average investment in the car, which is nothing but the initial cost of the car, which is 10 lakhs, plus the scrap value of the car 5 years hence, which is 4 lakhs, divided by 2, which is 7 lakhs. This is your average investment. So 1 lakh divided by 7 lakh is your ROCE formula, using by, this is approximately 14%. This is your ROCE formula basis the average investment method. Now, one question will be, what all does the initial capital cost include? It's easier for me to give an example that a car will be costing 10 lakh rupees. What all should that include? What if you don't buy a new car, but you take an existing car which is going to be used for your business, but instead of that, you are going to use it for personal purposes now? What does that happen? So initial capital cost can either be the cost of the new asset purchase, which in our example was the new car, or it could also be the net book value of an existing asset that you're using. Let's assume your dad already had another car. He gave you that car. Now, one might think there is no cost because his dad has given you for free, but there will be a cost, because if you would have sold that car, you would have gotten something, and there'll be some book value of that car in the books of your dad. So the book value of that car is what you have to take over here as the initial capital cost. The third one is investment in working capital. When you start a particular project, you start a particular business, you have to produce a particular stock, for example, if it's a manufacturing business. And until that stock gets sold, there will be, of course, an investment in that inventory. Similarly, when you sell goods, let's say your first customer is your best friend. He comes and says, in your cafe, for example, first customer is your best friend. He comes and says, or probably your girlfriend, who comes and says, I want to have a coffee. Of course, you'll treat him or her with a coffee. Now, when it comes to money, your friend will say, Yeah, this month my pocket money has already gotten over. Let me come back and give you the money next month. Now, the question, of course, is whether he'll return you the money or not. But let's assume he returns you the money. For 1 month, you will have invested your money in receivables, which will form a part of your capital cost. Last but not the least, there will be capitalized R&D expenditures. Let's assume, Pfizer, when it made the COVID vaccine, they would have invested a lot behind finding that right vaccine to treat COVID. That is nothing but the expense that is made towards that is nothing but the research and development expenditure that they would have made, which we have to amortize in profit calculations. I'll come to the calculations later, but think of it as similar to depreciation. If you have invested 1 crore rupees in R&D before the project starts, right? This is before the project starts, right? Then, and if it is you getting used for 5 years, then 1 crore divided by 5 years is your 20 lakh, which is the amortization that you will be making. And this is something that you will be deducting from the profit that you will be calculating, because to earn that profit, you had to invest 1 crore upfront, which of course over a period of 5 years was amortized. Correct? Now, how do you decide? Now, we understood what is the formula, what is the percentage. By the way, this percentage, think of it as if a fixed deposit gives you 7% per annum. What is that 7% per annum? That is nothing but return on the capital that you have employed in that fixed deposit. That is the ROCE, which is the ROCE. Now, how do you decide if a particular percentage is good, bad, ugly, whether you should invest in that business, not invest in that business? The answer is, if your ROCE, which in this example, the 7% that you're earning on your FD, is it higher than the target that you've kept for yourself? Let's assume that the target you had kept was 10% per annum and the FD gives you only 7%, then you will reject the FD. And if the mutual fund gives you 12% per annum versus your target was 10%, then you will accept the investment in the mutual fund. Similarly, when it comes to the CFO, if a particular project is earning the ROCE higher than the target that is set by the management, he will end up accepting the investment. Otherwise, he will end up rejecting the investment. Why don't we go through a couple of examples, and that is how we'll be able to understand this concept better. And we'll be over this entire course, we'll keep solving practical questions, because eventually that is what you have to solve in exams in order to get marks. Let's take the first example, which is there's a plant which is costing 1,10,000, which is 110K. That plant will generate an annual cash flows. Is this profit? No, this is cash flow. In the subsequent topic, we'll discuss more in detail about what is the difference between profit and cash flow. But for now, assume this is not the same as profit. Cash flow of 24,400 rupees, and the plant that is purchased would have a scrap value of 10,000. Now, if we use the first, which is the initial capital cost method, what is the formula? The formula was average annual profits divided by the initial capital cost that you would have invested into 100, which is nothing but the percentage that you will understand and come to know. How do you calculate this? What is the average annual profit? The profit over here is nothing but the cash flow that you've earned, and there will be a depreciation cost. You would have studied in FR and accounts that depreciation is a non-cash expense. So the depreciation over here is calculated as nothing but the initial cost minus the scrap value divided by the life of the asset, which over here is 1.1 lakh minus the 10,000 divided by 5 years, which is nothing but 20,000 per annum. Now, what are your average annual cash flows? Your cash flows are 24,400. What is your annual depreciation? This is your annual depreciation, which is 20,000, and hence 4,400 is your annual profit. Now, if we go back to the formula, which is initial capital cost method, ROCE as per the initial cost method, then your average annual profit divided by the average or divided by the initial capital cost, which is nothing but in this case 1,10,000, which is on day one. How much did you spend on the car on day one? You had spent 1,10,000, and hence 1,10,000 into 100, which is nothing but 4%. So the ROCE as per method A is nothing but 4%. As per method B, your average annual profits remain the same. Your average annual profits remain the same as per method A. But what changes? The average investment is what changes. The denominator changes. The denominator over here was initial capital cost. The denominator over here is average investment. What is your average investment? The average investment, if you remember the example that I gave you of the car, is it the 10 lakh that you invested on day one? No, it is a 7 lakh rupees. So how do you come to that 7 lakh that I'm giving you example for the car? It is nothing but the initial amount invested and the amount finally realized as the scrap value. So 1,10,000 plus the 10,000 divided by 2. This is the average value of the investment over the course of your life, which is nothing but 60,000. Now, given this formula, your average annual profit was 4,400, and your average investment is 60,000. So no, not so many zeros. Don't get too excited. So this is nothing but, just use your calculators. It is nothing but 7.33 percentage. This is the first example. I hope it is by now clear what each of these methods is about and what is the logic behind each of these cases. Coming to the second example, which is your initial investment is 8 lakh. Now, your annual profits or your annual cash flows are actually different. Unlike in the previous example, where your annual cash flows were the same, they were 24,400 every year. Over here, your annual cash flows are very different. At the end of 7-year project, the assets initially purchased will be sold for 1 lakh. So this is nothing but your scrap value. How would you calculate the ROCEs using each of these methods? So the first method, which is ROCE by the initial capital cost method, would be the average annual profits. I'm using short form over here, the average annual profit divided by the initial capital cost. Now, what is the total profit? So if you actually add all of these 100 plus 200 plus 400 plus 400 plus 300 plus 200 plus 150, your total profits across your life will be 1750. Don't forget, it is actually in thousands. The amount is in thousands. It's 1750,000. Now, like I told you in the earlier example, cash flow and depreciation are not the same. Cash flow and profits are not the same. For the sake of simplicity, the difference is depreciation. What is the depreciation over here? The depreciation over here is nothing but your initial investment, which is 800,000, less your scrap value, which is 100,000, divided by the useful life, which is 7 years. It is a 7-year project, so the useful life will be 7 years. So 700,000 divided by 7, so 100,000 will be your depreciation. 100,000 will be your depreciation per annum, but the total depreciation will be 700,000, which is nothing but 800,000 minus 100,000. So what is your total Sorry, this is not profit. This is actually cash flows. I'm glad I made this mistake purposely so that you can realize that cash flows and profits are not the same. Now, what is the total profit that you'll be making through this project over the course of the life of this project? It is nothing but 1750 triple zero, which is total cash flows less your depreciation, which is 700,000. So your total profit is actually 10,50,000. This is your total profit of the project. So what is your average annual profits? It is nothing but 10,50,000 divided by number of years, which is 7 years, which is nothing but 7 years. This number will come to 150,000. So your average annual profits is 150,000 divided by what was your initial capital? Your initial capital cost was 800,000. So just use your calculators to do the math. Of course, in exam, you'll have the benefit of a spreadsheet, which is 18.75%. Now, for those of you who are asking me, but sir, how did you do this? You did total cash flows and total depreciation. Why did you not do annual cash flows and annual depreciation? Let's start that out as well. What is your annual cash flow? Your annual cash flow would have been nothing but 17,50,000 divided by 12. So divided by 17,50,000 divided by 7, which is 7 years, which is nothing but 2,50,000. This is your annual cash flow, and your annual depreciation, as we had already calculated over here, your annual depreciation was 1 lakh per annum. So if you now do the math, which is if you remove this, then the profit on an annual basis is 1,50,000. The answer is the same. Is this magic? No, this is math. Now coming to the ROCE using average investment method. Of course, your annual profit of 1,50,000 remains the same, which is this is your average annual profit. This remains the same. Your average annual profit remains the same. What changes? The average investment changes. What is the formula of average investment again? The formula of average investment is nothing but initial capital cost plus your scrap value divided by 2. What was your initial cost? Your initial cost was 8 lakh. Your scrap value was 1 lakh. So 8 lakh plus 1 lakh is equal to 9 lakh divided by 2. So your average investment is nothing but 4,50,000. 1,50,000 divided by 4,50,000 is nothing but 33.33% as per method B. As per method A, the answer is 18.75%. Remember, in exam, you could be asked both the methods, or you could be specifically asked to solve using the average investment method. But if nothing is specified in the exam, what do? You go ahead with the initial capital cost method. Coming back, I hope by now your concept of what is the ROCE, what is average rate of return, what is the concept of ROCE is clear. So that's the end of topic 1. What are the advantages and disadvantages? And I know as a finance student, you might be like, I don't know why we study all of these theory concepts, because in real life, we have to do the math and take the decision. But these theory topics are important because number one, of course, they are going to be asked in exam. But more importantly, for you to know what is the right thing to do, for you to make the right decision, you will have to understand the concept very well, and theory will help you understand those concepts very well. Of course, in exam, you can explicitly be asked a question around explaining the features, advantages, disadvantages of ROCE as a method. Coming to ROCE, What is the biggest advantage? Biggest advantage is ROSI is like a WhatsApp message, as simple as it can be. So the ROSI method is a simple method. It is based on widely used accounting measure. In accounting, in FR, you have already studied what is the meaning of annual profit. So it is already based on what you do in accounting and FR, and hence you don't have to study a different subject. It is easily understood. I'm sure by now you've understood it. We've calculated two examples. I'm sure you agree with the fact that it is easily understandable and calculable. And as with you as an accountant or a manager, with you as the future CFO, it is very, very familiar. Like I said, it easily links to accounting measure because it is based on accounting principles. It is widely used in practice. A lot of people use ROCEs to compare shares or the performance of different businesses and sectors. It is expressed in percentage terms. For example, 7% of the on the FD that I had mentioned to you. It allows comparison across projects and companies. So if your one project is FD and your another project is mutual fund, which was giving you 12%, you can easily compare whether you invest in a mutual fund which gives you 12% or whether you invest in the FD which gives you 7%, and hence it is easily comparable. So one, it is simple. It is like that WhatsApp message. Remember, I'm sure when in exam you are asked to explain the advantages of ROSI, the first thing you will remember is the way sir saying it is like a WhatsApp message and hence it is similar. The second thing is it links with the other accounting measures. What are the disadvantages? Like anything in this world, everything has a disadvantage. What are the disadvantages? The disadvantage is that it ignores the length of the project. Now let's assume your 2-month FD and your 20-year bond both give you 10% as the rate. According to ROSI, both are the same investment. But are they the same investment? The answer is no. ROSIs do not account for the duration of the project. Let's assume you as an ACCA will end up earning hypothetically 15 lakhs per annum in your first job. And you could do some other course which would have taken you 8 years instead of the time that you're putting in ACCA, which is much shorter. You'd still earn the same 15 lakhs per annum. ROSI will ignore the amount of time that you have invested and hence the duration is ignored. There could be two projects, like I said, with the same ROSI but different lifespans, but they are treated equally. The example of 2-year project and a 10-year project. No timing of cash flows. So the numbers, it includes the numbers from a whole project life, but ignores when they occur. Now, if for example, you are again an ACCA student, let's say one of you ends up getting a job which pays you 10 lakh per annum, right? Which pays you 10 lakh per annum and it stays the same for 10 years. The other one gets a job which says you will get zero for the first 9 years, but in the 10th year, you will get 1 crore rupees. Now, the 10 lakh for 10 years will also end up earning the same 1 crore rupees, and the 1 crore in the 10th year will also be earning 1 crore rupees. Which one would you prefer? I am 100% sure all of you will prefer the first option. You will say, sir, what will we do for the first 9 years if we don't get money? That is the exact problem with ROSI. ROSI will say 1 crore divided by the 10 years is equal to 10 lakhs is your annual profit. But you will say, sir, life does not work that way. I have to give treat to my girlfriend today. I need that money today. And hence, this is the disadvantage with the ROSI method, which it does not take into account the cash flow timings. It does not differentiate between the early and the late cash flows. Someone getting 10 lakhs on day one, someone getting 1 crore on your 10, and hence it ignores the time value of money. The concept that I started this chapter with when I told you this is something that we will be studying in the next chapter. This is the main disadvantage of ROCE as a method. Profit measurement is subjective. I'm sure by now all of you have studied accounts and FR and know how you can treat profit differentially. If I was to ask you what are the standard ways in making the profit differentiated, there are a lot of examples that you will give, but few of those examples that would be top of your mind are, for example, instead of straight line method of depreciation, you can make it reducing balance method. Will the profit year on year be the same between the two methods? The answer is an absolute no. For straight line method, the depreciation remains same across years. For reducing balance method, the depreciation also keeps reducing, and hence your profit keeps improving over the last few years. The extent of cost capitalization, like I said, gave you the Pfizer example, which would have capitalized the cost of developing the COVID vaccine. The cost of developing is different, and a company may choose to capitalize or to expense it in the same year. It may either expense the entire thing in the same year, in which case the profit of 1 year will take the entire hit, or it may choose to amortize it over a period of 5 years, and hence the profit of 5 years will get hit. So the profit management is very, very subjective over here, in which case even identical projects which can give the same amount of profit be actually very, very different in terms of the ROCE, because their profits will be different based on depreciation method, capitalized cost, etc., etc. It may end up ignoring working capital. I told you working capital is the bloodline of any business. The business cannot survive without the working capital, but ROCE calculations will not include that example which I gave you, which is your friend coming and asking for that cup of coffee from you on day one after you opening that cafe. ROCE probably may not account for that working capital, or may underestimate. You may have thought one friend will come, there could be 10 friends who come, and hence it may underestimate, which may lead to a biased project selection. For all you know, all your friends keep coming to you and keep drinking coffees every day, and essentially you don't end up making profits. That is on a lighter note. Of course, I do hope you open that cafe and it turns out to be profitable. ROCE is not a measure of absolute gain. You can invest 1 lakh rupees, and at 7% you can end up getting 7,000, or you can earn 1 crore rupees and at 7% you can get 7 lakh rupees. Are these two absolute numbers the same? The answer is no. So the ROCE on a small investment but a large ROCE is actually worse. Or let me put it this way, if this number is 6%, you'll end up getting 6 lakhs. Is 6 lakhs better or is 7,000 better? Of course, 6 lakhs is better, but according to the ROCE method, you will reject this and you will say this one is correct. There is no definitive investment signal. There is no correct amount. Someone might say, I need 10%. Some of you who would have actually invested in crypto would say, I will not be satisfied under 50% year on year return. And hence, there is no objective target that is set for ROCE. It varies by company and industry. Some industries make a very high profit with a very high growth profile. They have a very high ROCE. A lot of industries are now stagnant with a decent growth. They do not make very high ROCE, and ROCE also is dependent on the amount that you invest. So the decision to accept or reject actually remains very, very subjective, which is why it makes comparison with the companies difficult. It makes comparison easy because the number is the same across companies, but the methodology of calculating the profit in different sectors, the right ROCE is very different, and hence the comparison actually becomes difficult. I had told you profits and cash flows are not the same. Profits are, think of it as if you are supposed to buy my classes today. You need money to buy. Your parents tell you, promise we will give you 20,000 rupees on the first day of the next month. Part of it you can use to buy classes, part of it you can keep for yourself. What do? That 20,000, you're sure your parents will actually end up giving you, which is the profit that you'll book in your books of accounts today. You will say, okay, I'm sure I'll get that 20,000. But can you buy my classes using that 20,000 of future? The answer is no. You need cash today. So cash flows are facts. Profits are opinions. Cash flows are facts. Profits are opinions. So you may think that the two are the same, but they two are very, very different. Can you make expenses? Can you go out on a date with that future profit? The answer is no. You need facts, which is you need cash in your hand to go on a date with your friend. What is the core principle? The core principle is that actually, when you decide whether you want to make an investment or not, you decide on the basis of cash flows and not profits, except for ROCEs. It is only ROCE that actually makes use of accounting profits. All the other investment appraisal techniques make use of cash flows. And this is the fundamental to investment decision making, that cash is God, cash is king. Why do we prefer cash flows? Number one, profits cannot be spent. Like I said, your parents promise to give you money in future. They cannot be spent. Similarly, for a company, if they are to give money to their shareholders, they can give only in cash, and hence cash can be spent. Profits cannot be spent. Profits can be very, very subjective. We just discussed that they are a matter of judgment, but cash is a fact. How much money do you have in your bank account? How much money do you have in terms of cash, hard cash at your home is a factor. Like I said, cash is required to pay dividends. You cannot promise your shareholders to give money at a particular point in time. You have to give cash. And finally, wealth transfer. So dividends are the only way to transfer wealth to owners. Just by having profit on your books is not sufficient. The right wealth made will be if they eventually end up receiving cash. What is a major difference? And this is what I was referring to when we were discussing example 1 and 2. What is a major difference between cash and profit flows? What is a major difference between cash and profit flows? Number one, of course, depreciation, like we discussed, because depreciation is a non-cash expense. Depreciation is a non-cash expense. Working capital is the second difference, where when you will sell that 100 rupees, actually, let's put it this way, the coffee you will sell will be of 300 rupees, not 100 rupees. When you sell that 300 coffee to your friend, you will already book your profit. But have you received that money today? The answer is no. So there is no cash flow. There is no cash flow, and hence your working capital will mean the cash flow you make is relatively lesser, but the working capital, because of the working capital, but the profit will be higher. You may end up purchasing one more coffee machine, which will take in the second year, you believe your cafe is running wonderfully and you decide to buy one more coffee machine. That is when your cash flows will take a hit. But will it take a hit in a profit? No, because your machine, you will say, I will capitalize it to my balance sheet. It is an asset. I have bought an asset. It does not affect my P&L. Vishal sir has taught us expenses, only expenses will go to the P&L. Assets will be going to the balance sheet, and hence asset purchase could be the difference between cash and profits. The next is deferred taxation, something that you'll study in FR if you've not studied already. But in summary, there are a lot of these expenses which the tax will give you a benefit of on day one, or will absolutely not give you the benefit, will say give you the benefit later. That expense you may have booked in the books of accounts, but the taxation will not give you a benefit. It is going to be deferred. And this could be the difference between cash. On day one, you may pay higher or lower tax than you're supposed to pay, versus the profit as per the accounting tax will be different. Last but not the least, capitalized R&D expense. The same Pfizer example that I gave you, Pfizer would have spent X amount in developing the COVID vaccine. They would have capitalized to their books and they would have kept amortizing over a period of time. But from a cash flow perspective, they would have had to spend on day one. So these are the typical differences between cash flow and profit flows. But realistically, from an exam perspective, the main adjustment typically will always be just adding back depreciation. So your cash flow is nothing but your accounting profit plus your depreciation. And if there are any other non-cash expenses, however, from an exam perspective, in all cases, they generally give only depreciation. But you should know that if there are other non-cash adjustments, then they could also be made. Now, are cash flows enough? Just cash flows are not enough. Think of it as if you are hypothetically, if you have spent, let's say, if you are deciding whether a movie is good or not, you already bought a movie ticket of 500 rupees. You've entered the theater, you've watched first 20 minutes of the movie, and now you are deciding whether you should continue watching the movie or not. Are the 500 rupees of cash flow relevant now? The answer is no. Why? Because you've already spent the money on the ticket. Now the choice is yours if you want to sit for the remaining 2.5 hours and watch the movie which you're not liking, or you want to exit the theater. In either of the two scenarios, the rupees 500 that you had spent is already gone. So the relevant cash flows is what matters from an investment perspective. The investment, whether you want to invest those 2.5 hours of time behind the movie that you're not liking, whether you should or not depends on relevant cash flow. And relevant cash flows are future, something that will happen now. You've already sat in the movie theater, it has been 10 minutes, 15 minutes, 20 minutes, and now you are deciding. So the cash flows that you will make now. Is popcorn a relevant cash flow if you've not already bought in popcorn? The answer is yes, and hence because that is a future cash flow, that is a relevant cash flow. Something that is incremental from what you have already done. 500 you've already spent. So the popcorn is incremental, and only if you sit through the movie will you spend on that popcorn and buy that popcorn, and hence popcorn is a relevant cash flow versus the movie ticket is not incremental, that has already been spent, it is not relevant. These should be based on cash. These should be based on cash. For example, the depreciation that I mentioned, depreciation is a non-cash expense. Depreciation is a non-cash expense and hence not relevant. Word. It could be, however, an opportunity cost. For example, I say, for example, a machine. I say, for example, a machine. You are deciding whether to buy the machine or not. Or actually, let me put it this way. You already own the coffee machine. You've started a cafe. You already own a coffee machine at home, but it is unused. You will say, I don't have to make any investment because I already have this coffee machine at home. But if you were to not start the cafe, if you were to not start the cafe, then you could have sold this coffee machine for 5,000. You could have sold this coffee machine for 5,000 instead of taking it to your cafe. And hence, what is your relevant cash flow? Your relevant cash flow is nothing but the 5,000 rupees that you would have actually spent on that coffee machine, or rather, that you would have gotten by selling that coffee machine if you were to not transfer it to your cafe. And all of these cash flows are direct consequences of making the investment. Only because you invested in a cafe, you started a cafe, did you take a place on rent? So it was a direct consequence of you undertaking the investment. You might say, oh, I bought a phone so that I can post good reels about this cafe. Did you buy the phone to post good reels about the cafe, or would you have either ways bought in the phone? If you have either ways bought the phone, then in that case it is not a direct consequence, it's just an added benefit. But if you bought a special camera just to shoot video reels so that you can advertise your cafe, then it is a direct consequence of the investment. These are the relevant cash flows that you consider. What to ignore? What is not relevant? The sunk costs are not relevant. Like I said, if you're going for a movie, you've already spent the 500 rupees in the movie theater. when you are in the movie theater, it is already incurred and cannot be recovered. Can you go to the cinema and ask for the refund? The answer is no, which means these are sunk costs, so cannot be recovered. Let's assume you are taking, let's assume you are taking a girl on a date or a boy on a date, as the case may be, and you really like him or her and you want to propose him or her. Now, let's assume you've already prepaid for the dinner, right? Now you're going to propose and you don't know what the answer is going to be. Is that a sunk cost or not? Yes, that is a sunk cost, because irrespective of whether the answer is yes or very unfortunately the answer is no, you would have already spent for that dinner. So in actual scenarios, when you decide whether you want to invest in a particular plant machinery and you have asked someone to do research for you, and he or she does a technical feasibility study or a market research of whether you should undertake that project or not, that cost is either ways getting spent, whether or not you actually invest in that particular plant or machinery. Costs that are committed, that will be incurred any which way. The same girl that I gave you an example of, if you had asked a friend of hers to get her to that surprise dinner that you have planned, now that friend of hers will say, I also want to get treated, irrespective of whether the answer is yes or no. That is something that you've already committed. Even if the answer is no, you will have to incur that cost, which is why this is also not relevant as a cash flow. Now, for example, there is a machinery that you're adding to your factory. You already are incurring, let's say, electricity cost, supervisor cost, right? By adding that machinery, your electricity or supervisor cost does not increase. It is already committed, then it is a not relevant cash flow, because you would have either way spent. It is not a direct consequence of you undertaking the investment in that machinery. All items that are non-cash, which do not involve any cash outflow or inflow, for example, depreciation, will also not be relevant. Last but not the least, all the absorbed overhead. Let's say after you buy another machine, the CEO or you as a CFO say, I will have to invest time. So put my salary, apportion it to this project. Would you have still paid the salary to the CEO or the CFO? The answer is, and of course, yes. Have you increased his or her salary for the additional burden? The answer is no. Then, in that case, this is not an incremental cost, and hence the cash flows are not relevant. What do you include? What is relevant costs now? If these were not relevant costs, what are relevant costs? The relevant costs or relevant cash flows, for example, the relevant cash flows, for example, are the direct revenues that you earn from the project. So it's the direct cash that you earn from the cafe that you had owned, and the direct costs that you spend, the cash cost that you spend while running the cafe, which you would have otherwise not spent. What are the opportunity costs? The example that I had given, which is the 5,000 rupees of your coffee machine, the 5,000 rupees of your coffee machine that you would have otherwise sold, but you have used over here, that is the opportunity cost. Some of you might say, okay, I want to start a startup. I have an extra house. My dad has given me an extra office. I will use that. So I don't have to pay any rent. But is there an opportunity cost? The answer is yes. If you were not using that office, if you were not using that house, it could have been given on rent to someone else and you would have earned that rent. So indirectly, there is an opportunity cost, even if you are not paying any rent to your dad. And finally, any incremental cost. So if you have added a machine and you need an additional supervisor, then in that case, that cost will be considered. Let us solve another example. A manufacturing company considers producing new types of widgets. Each requires 2 hours to make. Fixed overheads are apportioned on the basis of $1 per hour or pound 1 per hour. If new widgets are produced, the company will have to employ an additional supervisor at an additional salary of 15,000 pounds per hour, and it plans to produce 10,000 such per year. What are the relevant cash flows? So there are two costs that are given over here. The first cost is the $1 per hour per labor hour of fixed overheads. How many number of labor hours? Let's say 2 hours per widget, and such 10,000 you're planning to make. So it is 2 into 10,000, which is 20,000. But sir, why are we calculating this? We don't need this information because fixed overheads are not relevant cash flows. They are committed costs which were either ways going to get incurred, and this new project is not making that change, and hence fixed overheads get ignored. Is this supervisor needed even if we are not going to make this project? The answer is no. He is needed only if we are producing these new widgets. Otherwise, he is not needed. He is an additional supervisor, and hence the 15,000. So the relevant cash flows are nothing but 15,000, which is the cost of the additional supervisor. That is the relevant cash flows. The next example, a company is evaluating a proposed expenditure on an equipment that would cost $160,000. A technical feasibility study has been carried out at 15,000. It has already been carried out whether or not you make the investment. It has already been carried out. And hence, is this a relevant cost? It is not relevant cost. It is not relevant cost, and hence it does not matter that you spend that 15,000. It is like that dinner expense that you've taken, that you've already spent to propose your girlfriend. It is like that dinner expense which is already spent. It is not relevant. The equipment has an expected life of 4 years and an annual profit of 8,000 after deducting 40,000 depreciation and 20,000 for share of fixed costs. What is the profit? The profit is 8,000. But this is after deducting depreciation. Is depreciation a non-cash item? The answer is yes. So you will add back depreciation. The 25,000 is the share in the existing fixed costs. The fixed costs are already existing and will continue to be so even if we do not undertake the project, and hence the annual cash flow. This is the profit, and these are the non-cash expenses, and this is the committed costs. All of these are not relevant, and hence cash flow the total total cash flow will be 40,000 plus 25,000 plus 8,000, which you will be total investing, and hence the number is 73,000 versus, so this is the annual profit that you will consider, and annual relevant cash flows versus an investment of 1,60,000 investment. So this is what you will consider for the purposes of your decision making. The next example, and this one is an interesting one. This company is considering a new project. The machinery was purchased already 80,000 7 years back. This is like that coffee machine that was kept at your house, remember, which you could have sold at 5,000. The life of the machine is 10 years. It is idle, it is not being used, just like your coffee machine was not being used at home. And it would be scrapped at 5,000. Just like you could have sold your coffee machine at 5,000 if you're not going to take it to your cafe. Similarly, this machine would have been scrapped at 5,000. But if it is used in this project, before we go ahead, this is the classic example of opportunity cost. Have you bought the machine? The answer is no. You already had this machine. You've not bought the new machine. You already had this machine. But while you've not spent any money, you could have gotten money by selling that money and selling that machine. And hence your opportunity cost is 5,000, which is your relevant cash flow. If it is used in this project, it has no residual value. If you use the coffee machine at your cafe, it will no longer have any residual value. In fact, the disposal of it will cost 1,500. Today, is there a disposal cost? The answer is no. Today, if you sell it, you will get 5,000. You will get 5,000. You wouldn't have to spend 5,000. But if you use it, then there will be a residual value and disposal cost of $1,500. So what is your total relevant cash flow? Your total relevant cash flow is nothing but 1,500, which is your disposal cost, which will incrementally happen again. If we go back, which will incrementally happen in future, which would have otherwise not happened. It will happen as a direct consequence of you making the investment. It will happen as a direct consequence of you making the investment plus the opportunity cost of 5,000. So total relevant cash flows are nothing but 6,500 total relevant cash flows. Over here, the original cost of 80,000 is not relevant because that had already been spent 7 years back. And the accumulated depreciation of 56,000 is also not relevant because it is a sunk cost. It is like that 500 rupees of movie that you have already spent, and it does not matter. That does not matter. So that is all about relevant. That is all about relevant cash flow concept. What is your decision framework? How do you decide? If the cost has already been incurred, then you ignore it. Has the cost not been incurred? Will it be incurred in future? Then the answer will be you have to consider it as a part of the relevant cash flow. This is like that new supervisor salary. Will it incur regardless of the project? Will you have to treat your friend's friend regardless of whether she says yes or not? If you will have to regardless treat her, then you have to ignore it. It is a non-relevant cash flow. But if the cost is getting incurred on the supervisor only for this project, then you have to consider it in the relevant cash flow. Is it cash? Is depreciation cash? The answer is no. Then you ignore it. If it is cash, if you're actually getting money, then you have to consider it. Is it incremental to the project? Will it be incurred? Will the new supervisor cost be incurred because of this project? The answer is yes. Then you consider it. Otherwise, you ignore it. The answer is no. Over here, we've pretty much finished 60 to 70% of this chapter. We will take a short break of 10 minutes. And if you have any questions, I am around. Feel free to put those questions in the chat box. We will then come back and talk about the payback period method. See you soon. everyone, welcome back to this post-break session of the first lecture of the ECCA Financial Management batch. We've already discussed the concepts of ROCE and accounting profits versus cash flows and relevant cash flows. In fact, I just came up with an analogy and I was thinking, and this is very deep, by the way, that profits are like those Instagram likes that we crave for but which actually don't have any meaning. And cash is like your bank balance that practically gives you the luxuries of life. I know this has a very deep meaning, but that's an analogy that I wanted to give that profits are opinions, they are still illusionary, but cash flows are facts. Coming to the next method, this chapter, as a reminder, had two methods. One was ROCE, which is return on capital employed, and the second method was payback period method. Just checking if all is going perfectly well. I guess it is. Hello, check. Yes, it is perfect. So on coming to the payback period method, at the highest level, payback period is nothing but deciding in what time period do you get your money back. Now imagine you've given money to your friend, right? Who says I will return you the money with a certain amount of profit in some period of time. And what you are concerned about is not the profit, but you say, अरे कैसे पैसा आएगा, कितने दिन में पैसा आएगा. That is what you are concerned about. And this is nothing but payback period, which is in what period of time will you get the amount that you've originally invested, in how much time will you get it back. So it is the time that a project takes. It is the time that a project takes to pay back or recover the initial money. So you've paid whatever, let's say 1 lakh rupees to your friend and he says he'll give it back to you with 10% return in a year, but you are concerned about getting the initial money back. When will you get the initial money back? It is based on the expected cash flows. Again, this is cash flows and not profits. This is cash flows, and it provides a measure of liquidity and risk. It provides a measure of liquidity and risk. What are the decision rules? What are the decision rules for ROC? The decision rules of ROC is if there are two projects, you choose the one with the higher ROC, or if you are evaluating a project, you decide if it is higher than the threshold that you had set in terms of the company's ROCE. It is higher than the threshold ROC. Similarly, over here, if there are two options, you will choose the one with the fastest payback. If there is an option which gives you money back within 1 month, if there's another option which gives you back money within one year, you'll choose the 1 month option because you get the money faster over here. Similarly, there may be a policy of a company which says I want to invest in only projects that give me money back within 3 years. So for those projects that give money back within 4 years, they will get rejected, but 2 years will get accepted. So that is how you make the decision as far as the payback period is concerned, and it acts as a screening tool. Points like these are relevant from an MCQ perspective, as your section A and section B are objective type questions. Points like these can be asked you in your objective type questions, which is it acts as a screening tool to eliminate obviously inappropriate choices. There is a choice which pays you back your money, in 15 years. Will you go for that choice? The answer is no. Now, coming back, payback with constant annual cash flows. Now, let's assume you are on a fixed salary and you keep getting 10 lakh rupees every year and you've invested X amount in doing the ACCA course. You will decide if you've invested, let's say, or maybe any other course, you've invested, let's say, 10 lakh rupees, right? And your annual cash flow is 10 lakh rupees, then within 1 year, you will get back your money. But this is where your cash flows are constant. Let's say where you are salaried, for example, where your cash flows are constant, you can consider this. Let's take an example. You have invested 20 lakh pounds. And the project is expected to generate 5 lakh a year. For the next 7 years. What is the payback period? What is the formula of the payback period? How much did you invest originally? You invested 20 lakhs. Per annum you are getting 5 lakhs. So you will get back your money within 4 years. You will get back your money within 4 years, and hence your payback period is 4 years. So what happens to the money that you get between 4 and 7 years? From a payback period method perspective, that is not relevant. You disregard. All you are concerned about is within what period of time will you get back your money, which is 4 years in your case. Payback with non-constant flows. Now let's assume in earlier case you were a salaried individual, and in this case you are a freelancer. In this case you are a freelancer where your incomes are uneven. In 1 year you will earn nothing, in another year you will earn a crore. So how do you solve this? I'll explain this to you with an example. But effectively, the payback occurs in a year when the cumulative becomes positive. Let's say to become this freelancer, you would have spent, let's say, 20 lakh rupees. First year you earn, year 1 you earn 0. Year 2 you earn, let's say, 1.5 lakh. Year 3 you earn 10 lakhs. Year 4 you earn 10 lakhs. What is the payback period? The payback period is nothing but, so of course first year how much you earn? Total 0. Till second year how much did you earn? You earned 1.5. Third year you earned 11.5 lakhs, but you have to pay back the 20 lakhs. Assume you had borrowed 20 lakhs from your dad and you have to return the 20 lakhs. When will you be able to return it to him? Till third year you would have returned only 11.5 lakhs. You will still have to return another 8.5 lakh rupees. But if in year 4 you earn 10 lakh rupees, so effectively what is the outstanding amount at the start of year 4? The outstanding amount was 8.5 lakh. What is the cash flow of the year 4? The cash flow is 10. So effectively 8.5 divided by 10. So your answer, what is 8.5 divided by 10? Into number of months, which is 12, into 12, which is 10.2 months. So your answer actually over here is, Dad, I will be able to return the money to you in 3 years and 10.2 months. But the ACCA Institute says, what is 10.2 months? Round it off. But round it off upwards, because we are pessimistic. We don't believe you will be able to give us the money in 10 months. You will be able to give the money in 11 months, but not 10 months. And hence the answer here will be 3 years and 11 months. Always round the months up and not down, because in 3 years and 10 months you would have not earned the entire money. It will take you the 11th month to earn the money. So always when you have to pay back, assume the analogy of you having borrowed money from your dad to do the ACCA course or any other course in university, and you have to return back the money to your dad. When will be able to return the money? In first 3 years you would have returned 11.5 lakh. In the 4th year you have to return another 8.5 lakh to him, which means 3 years and 11 months it will take for you to return the money. So that is payback. Now let's take another example. This project involves spending 18 lakhs. And annually you'll earn 3.5 lakh every year. So what is your payback period? So the payback period is nothing but your initial investment, which is your 18 lakhs, divided by your annual cash flows, which is 3.5. Take your calculators. So your 18 divided by 3.5 is nothing but 5.1428 years. Now what is 1428 years? So what will you do? You will do 1428 in terms of months. So 12 months into 0.1428. So it is effectively nothing but 1.7 months, which you round it off upwards. People are not confident of you in returning in 1 month. They will expect you to round it upwards, and hence the payback period will be 5.2 years. Let us take another example where the cash flows are actually uneven. Over here, if such an example comes in your such a question comes in your exam, what do? You basically draw a table which says cumulative cash flow. Cumulative cash flow. What is the total cash flow in year one? Year one, how much did your dad give you to do ACCA? In this example, he gave you 1900. In first year, you earned 300. So minus 1900 plus 300 is equal to minus 1600. He will say, you are still yet to give me 1600 rupees. Next year, you will give him another 500. So minus 1600 plus 500, you are still yet to give him 1100. The next year, you give him another 600, which means you are yet to give him another 500. Minus 1100 plus 600 is minus 500. This year, actually you give him 800 rupees. Dad, I earned more than what you had given me to do ACCA. I have earned more. Very good, beta. And if this continues, by the end of year 5, you would have earned 800 more than what your dad gave you to do ACCA. What is the payback period now? Have you returned the money till year 3? The answer is no, because this is still negative. Have you returned the money by the end of year 4? The answer is yes, because this is positive. You have earned surplus money. So how much money have you what is the payback period? Because somewhere between year 3 and year 4, the answer becomes 0. When does the answer become 0? So you had to give your dad 500 rupees at the start, which is, if we go back to the formula, at the start of the year, 500 was outstanding. At the start of the year, 500 was outstanding. And at the end of the year, you ended up earning 800. So total 500 by 800 is the number of months, which is 0.625 years, which in months will be 0.625 into 12, because 12 months a year. I'm sure all of you know that, which means 7.5 months. And if it is 7.5 months, remember ACCA Institute says we are not sure of you returning in 7 months, but we are sure of you returning in 8 months. So always round upwards. But are you returning in 8 months? No, don't forget that you did take 3 years. So you actually took 3 years and 8 months to return that amount. This is payback period. Coming back. We have done all the examples. What are the key notes? Negative cumulative suggests that recovery is incomplete. Till year 3, it was a negative cumulate of 500. And in year 4, it was a positive cumulate of 300, which means payback achieved. So payback was achieved in 4 years. Was it achieved in year 3? The answer is no, it was achieved in 4 years, 4th year, which is why the answer was 3 years and 8 months. When there is a fraction, you always do outstanding divided by the year's cash flow. What was outstanding? 500 was outstanding at the start of the year 4 and 800 was the 4th year cash flow. Always round the month up. See, such notes, key notes will be given throughout the study notes that you'll be doing, so that you remember while writing the exam that this is specifically something that Divesh sir had both taught as well as mentioned in the notes, which is why these are explicitly mentioned. What is the timing of the cash flow? Assume even distribution through the year. One can always say, sir, but 800 I would have earned at the end of the year, in which case it should have been 4 years. But no, you have to assume every month your income is the same unless stated otherwise. Going to the advantages and disadvantages of payback. The biggest advantage is this also is like a WhatsApp message, which is very, very simple. You remember, paisa dost se kab milega? When will you get back that money from your friend? This is the simple and easily understood concept with simple calculation of initial investment divided by the annual cash flow. divided by the annual cash flow. No complex formula, very simple, and it is suitable for everyone. It is suitable for every such friend who lends money to his friend and says, when will I get back that money? And this allows decision making transparently. When your friend says, I will return the money to you within a year, this is a transparent decision making. When is payback specifically used? It is specifically used when that technology is rapidly changing. For example, mobile phones. Mobile phone, if a company is making a model for a mobile phone, it is important for them to know. For example, Apple has released iPhone 17 Pro and they have invested a certain amount. It is important for them to know when will they get payback of this amount, because for all you know 18 Pro will be released soon, and hence in the midst of such rapidly changing technology with rapid obsolescence and frequent changes, where a new plant is likely to be scrapped in a short period, iPhone 17 will be stale and there will be a new model. Quick payback is vital. Improving investment decisions. When you know that the business environment right now is not so good, a lot of people say, no, a share market is not looking good, why don't you put money into the FD until the market improves? Once it improves, you can always take out your money. So in such a period, payback is absolutely helpful. So such projects that release your funds fastest to allow reinvestment when the opportunities get better. And it helps you taking tactical advantage in the changing markets when investment conditions are rapidly changing. When you know the markets are going to become better, you will invest in such opportunities which have a very, very quick payback. It favors quick return projects where they know the capital recovery, which is dost ka paisa fatafat milega. It favors those particular friends which give you money in time. It has 3 perceived benefits. One is rapid company growth. So people say, if I rapidly get the money back that I had invested, then I will be able to use it for reinvestment. I will make another investment if I get back the money, which is why my company will grow fast. However, this may overlook more profitable opportunities which are long term. You may invest in that FD at 7%, which has a maturity of 6 months, but there may be a bond with a maturity of 5 years at a 10% return, which you will ignore because you want the money in 6 months. That is going to be the issue. And hence, the growth strategy, when you use in the payback period, the growth strategy is going to be biased towards short-term projects. It's going to be biased towards short-term projects. Risk is going to be minimized. The shorter payback, if your friend pays you back in time, in less time, then there is less uncertainty. You know your friend is today your friend. There is no fights between you. His financial condition is good. He will pay you back. And hence the risk is minimized. But the longer he takes to pay you back, there is a higher risk that the payment will not be made. Because the earlier the cash flows, they are more predictable. As you keep going longer, the risks have a higher probability of getting played out in life. And hence, in a short period of time, cash flows are more predictable and they can address. Payback period addresses time related risk. There could be a lot of risk. There is market risk, there is competition risk, but not all risks are time related. Payback period addresses all the time related risks. It maximizes liquidity. Why? It says, when do I get back my money? Cash is king, cash is God. I want my money in my bank account. And hence it improves the company's cash position. And such more liquid position provides for operational flexibility. Like I told you, even if a company is making good profit, but it does not have money to pay salaries, this good profit is of no use. What is important? Cash position and operational. Cash position is important for the operational flexibility. However, liquidity issues can be better addressed through cash planning and cash forecasting, which you as the CFO will be, of course, doing. This method uses cash flow and not profits. Unlike the ROCE method, which had a big disadvantage, if you remember, which used the accounting profit. It used the accounting profit which are very subjective. It used the accounting profit which are very, very subjective. It used the subjective accounting profits, but payback period uses cash flow. Payback period uses cash, actual cash, and hence it unmasks all the optimistic profit figures that are masked by the depreciation policy. The example that I give you, which is your parents have promised you to give the money to you next month, not today. Today you will have profits, but you will not have cash. But next month when you have cash, you'll be able to buy the lecture. Payback period effectively considers the actual cash, and hence it is more transparent than the profit-based measures. However, it ignores the post-payback cash flow. Let me give you an example. You and your friend, after completing ACCA, start a job and get a job of 20 lakh rupees on day one. Let's say your father had lent you 1 crore rupees. Both of you will be able to return it in 5 years, right? Or let's say your father had actually lent you 20 lakh rupees. Both of you will be able to, this is 20 lakh per annum. Both of you will be able to return it or pay it back in 1 year. Now what happens is your friend's job increases to 25 lakhs next year, 30 lakh the year after that, 50 lakh the year after that, and 1 crore the year after that. However, you stay at 20. You stay at 20. The issue is, from payback method perspective, both of you will have 1 year payback. Both of you will have 1 year payback, but actually who is going to earn more? The one who is going to have an increasing pay will earn more. The issue is all the cashbacks, all the cash flows that happen after this payback period of 1 year are completely ignored. So it will ignore the fact that your friend will end up making 1 crore fixed pay in the 5th year and you will still be at 20 lakh. It will ignore that fact because it will say, okay, you are both earning 20 lakhs in year 1. You are returning my capital in year 1. For example, a project with a 3-year payback which is earning 1 million a year, in year 4 or 5 treated as the same which is earning pound 10. Think of it as 3-year payback. Both have the 3-year payback period, but in the 4th, 5th, the second project is earning only 10 pounds and the first project is earning 1 million. Actually, which project should you have chosen? You should have chosen the 1 million one, but you end up choosing the 10. You could end up choosing the 10 one if it has 2.9 instead of 3. If it has a lower payback period, you end up choosing this despite the fact that this is a lower profit. And hence it can lead to rejecting highly profitable. It can lead to rejecting the one with 1 million because these are longer term projects. So it ignores the total project profitability. The example that I gave you, which is 20 plus 30 plus 50 plus 1 CR, is greater than 20 into 5. It ignores the timing within the payback period. Remember, I had given you one example in the ROCE as well, which is you can earn 10 lakh for 10 years and still earn 1 crore, or you can earn 0,000 for 9 years plus you can earn 1 crore in year 10. What is better? Both the cases, the answer for payback is 10 years only. The answer for payback is 10 years. But what is better? This is better because this gives you 10 lakh rupees every year to spend. Remember, I had given you this example. What would you spend? How will you take your girlfriend for those dates that you wanted to, unless you have annual recurring cash flows or you have money you're getting every year? The issue is this treats the pre-payback equally regardless of the timing. Even if you get everything on day last or you get average on each year, it treats it equally. There is no distinction. Example, 500k in year 1 versus 500k in year 3 are treated identically. However, the time value of money, which we'll study more in the next chapter, is actually says the money today is worth more than the money worth tomorrow. This method is also not objective. This also is subjective because there is no right answer. How many years is the right payback period? If you ask me, if you ask Arjun sir will say 20 दिन में पैसा double. I want my money back in 20 days. But Is the answer right? 2 years, 3 years, 5 years? The FD example that I had given you, which is 7% in 6 months and the bond of 5 years, what is the right amount? It is very, very subjective. This is a management subjective. One company's payback is not another company's payback, because every management will look at life very, very differently, very, very differently. And hence it makes comparison between projects and companies very, very difficult, because everyone will say the answer is different for me, and different companies have different norms. Lastly, and hence, of course, these two are connected points. The subjective investment decisions, there is no definite accept or reject. It is there is lack of objectively set hurdle rate, and the decision making remains subjective because it is very, very subjective based on who the management is. It ignores the project profitability because it focuses only on cash recovery. It doesn't matter whether I make profit or not. I just want my cash back. The same example, दोस्त पैसा कब वापस दे रहा है, whether or not वो दोस्त profit कमा के दे रहा है, it doesn't matter. I want my money back. Even if this 10 million or this 1 million is actually greater than 10, it doesn't matter. If I get the $10 earlier, I will choose that. And hence, a 2-year payback with zero profit. If I get, there's a project which gives me my entire money back in 2 years, but there is another project which looks good on payback, which gives me back money in, for example, which gives me back money in 1.5 years, but let's say there is no profit. I will probably still go for this. I'll still go for this versus a project of 2 years which will end up making profit. And hence, this will not take account the longer term business profits. This is the big issue. With this, we've completed chapter number 2. At least from a conceptual perspective. We will, however, do not go. We will still end up solving the questions. We'll end up solving the practice questions as well. And I've purposely, if you see, not given any solutions together, because I want you to take an attempt at solving these first and only then actually solve the questions separately or actually see the solutions. I want you to first try your hand at solving these. Let us do that together. Which of the following is an example of relevant cash flow to be considered in an investment appraisal process for a new project? Market research expenditure already incurred. This is already incurred. Is this an incremental expense? The answer is no. This is a sunk cost. So is this a relevant cash flow? The answer is no. Additional tax that will be paid on extra profits generated. If I generate extra profits, there will be an additional tax. Is this incremental? Yes. Is this a direct consequence of the profit that I will be generating? The answer is yes, and hence this is a relevant cash flow. Centrally allocated overheads that are not a consequence. If they are not a consequence, then they are not relevant cash flows. Similarly, tax allowable depreciation. Depreciation is non-cash. Depreciation is non-cash. And hence it is not a relevant cash flow, which means the answer here is B, which is the additional tax that will be paid on the extra profits that you will generate. Next one, which of the following is an advantage of the payback method? I had told you such questions can be asked in objective type questions, and hence it is absolutely important to read and understand and learn the theory. Let us read through the options. It takes into account the timing of the cash flows within the payback period. Does it take into account the cash flows? Even if you receive the same amount in year 1 or year 3, or in my example, 10 lakhs every year or 1 crore in year 10, does it take into account? The answer is no. So this is actually a disadvantage. It uses accounting profits rather than cash flow. No. ROCE uses accounting profits. Every other method apart from ROCE uses cash flow and only cash flow. So it does not use accounting profits. So this is also not an advantage. It takes into account of the cash flows after the end of the payback period, and hence therefore the total project returns. It actually does not take into account the total project returns. It focuses only on the payback period, and hence this also is a disadvantage. As you could have seen here, it ignores the timing within the cash flow. It ignores post payback cash flow. And it ignores the total project profitability. It can be used as a screening device as a first stage in eliminating obviously inappropriate choices prior to more detailed evaluation. which is something that I had told you such questions can be asked. This is the one that I told you such questions can be asked. And this is actually one of the advantages of payback period. So the answer is D. ROCE project length, such you can expect such MCQs and objective questions. You can expect such objective questions in exams, 2 marks each. The return on which of the statements is not true? Which is not true? Return on capital employed method takes into account the length of the project. We'll come back to this one. Focus on an early payback period can enhance liquidity. Can it enhance liquidity? Yes, it can enhance liquidity because payback period focuses on liquidity and cash is king. Investment risk is increased or the payback period is longer. The answer is yes. The payback period, the shorter the better. The payback period, the shorter the better. If you look at the decision making criteria, the fastest payback is the better. The fastest payback is the best option. Shorter term, so hence these both are true. Shorter term forecasts are likely to be more reliable because the risks are more easily predictable for the shorter term versus for longer term. All of these are true. Now, why is A not true? The return of capital employed does not take into account the length of the project. It only considers the average profits. It does not matter what the length is. I'll take you back to the disadvantages. It ignores the length of the project. A 2-year project or a 10-year project, both having the same ROCE, 2-year project may be preferred. This is the example I had given you. A 2-month FD or a 20-year FD, both may have 10%, but it will ignore and it will say both are the same, which is the disadvantage of ROCE, and hence this statement is incorrect. So the answer here is A. The integrated payback and ROCE. This is one that I want to solve with you properly. So why don't we solve it here? ACCA purchases a machine for 1,10,400, operated 4 years, sold 9,600. So this is the scrap value. Straight line depreciation. So what is the depreciation? Annual depreciation would have been nothing but 1,10400 minus 9,600 divided by 4 years. This is nothing but 1,10400 minus 1,10400 minus 9,600 divided by 4, which is 1,0080 divided by 4. The answer is 25,200. This is the depreciation. What is your annual profits? Be careful in exam what is given. Are you given profits or are you given cash flows? Over here you are given profits. Profits are given to you. You have to find out both payback period and average ROCEs. By the way, in examination, you can very well be asked to actually compare both payback period and ROCEs. You can be asked to compare, where you have to give a theory illustration of how, or rather theory explanation of how these two compare with each other. Right now, why don't we actually calculate payback period first? Payback period is nothing but initial investment divided by annual cash flows, but that is if the cash flows are consistent. Cash flows are same every year. Are the cash flows same every year? The answer is no. So let us first make a table of year profit cash flows. Year 1 profit is 39,600, but the cash flow is nothing but 39,600 plus the depreciation. This is the cash flow, which is the cash flow. So 39,600 plus 25,200, 64,800 is the first year cash flow. Second year, your profit is 19,600 plus 25,200, which was your depreciation. So 19,600 plus 25,200, it is 44,800. Your cash flow for second year is 44,800. Third year, your profit was 22,400, depreciation was 25,200. So 25,200 plus 22,400, 47,600 is your third year cash flow. Fourth year cash flow is nothing but profit of 32,400 plus your depreciation of 25,200 plus your depreciation of 25,200 which is 57,600. Now for payback period where the cash flows are uneven, remember you have to create a column of cumulative cash flow. What is your cumulative cash flow over here? By the way, for year 0, I should have mentioned it over here. For year 0, you actually have a negative cash flow of minus 110,400 because you've invested 110,400 in year 0. So year 1 cumulative is nothing but 110,400 plus 64,800. So minus 110,400 plus 64,800, which is 45 minus, which is nothing. Okay, I guess one sec. Okay, I guess looks like the battery is over. Why don't I solve it here on my calci, and you can keep noting it down. So 64,800 is your first year cash flow, less 110,400 was your investment. So 45,600 is your year 1 negative cash flow outstanding. So cumulative cash flow is negative 45,600, and in second year you end up making 44,800. So by end of second year you would have only negative, okay, it's working somehow, I don't know. Let us try. Doesn't look like, no problem. So second year is negative 800. Now year 3 is where you end up recovering your money. So negative 800 plus 47,600, which is 46,800. So in year 3 you would have recovered the entire money. This is the year when you go to your dad and says that I have earned everything that you had given to me for doing ACCA. What was the formula, if you remember? The outstanding investment as of day 1, which is negative 800, outstanding investment as of day 1, which is negative 800, plus or rather divided by the total cash flow in that year, which is 47,600. So 800 divided by 47,600, which is the cash flow for your year 3. So the answer is 0.016. So effectively 2 years and 0.016 years. So effectively of these 4, the option should be either A or D, because the payback period is 2.02 years. Of course, in MCQs, there may still be a decimal answer, but if it is a proper answer where you have to calculate, you will have to write what 0.02 in terms of months means, which is nothing but 0.2 months, and hence you'll have to round it off and say 2 years and 1 month. You'll have to round it off and say 2 year and 1 month. What is the ROCE? Now your ROCE will be nothing but your average profit divided by average investment. What is your profit? 39,600 for year 1 plus 19,600 for year 2 plus 22,400 for year 3 plus 32,400 for year 4. Your total profit is 1,14,000 for 4 years. Your average is nothing but divided by 4, and hence 28,500 is your average profit for these 4 years. What is your average investment? They've clarified to you in the question the method of the ROCE. It is not the initial capital cost method. It is the average investment method. And I told you, if nothing is mentioned, you go for the initial capital cost method. But if they have clarified what the method is, you have to go for that particular method, which over here is the average investment method. For average investment method, what is the formula? Initial capital cost, which is 1,10,400 plus the scrap value, which is 9,600 divided by 2. So 1,20,000 divided by 2, which is 60,000 is your average investment. What is your average profit? 28,500 divided by 60,000 being your average investment. The answer is, your answer on ROCE is option A, which is 47.5%. That ends our chapter 2 with all the questions. Of course, there's ACCA Study Hub where you have to practice additional questions of this chapter, but as such we've completed the questions of all the concepts. At least one question per concept we've done, and these notes will also be uploaded on your OBS system, so please do refer to these notes. And if there are any queries, absolutely, you have my WhatsApp number, it is given in the description. If you're not a student, you want to enroll in the batch, The details of the batch are given on the website, the link of which is also shared in the description. And you can also reach out to me on WhatsApp. My number is given in the description below. Like I mentioned, these notes also have a proper chapter summary, concept summary of the entire chapter for the last 2-3 hour revision before the exam. It also has exam tips and strategies basis the frequent mistakes that the students make. And like I said, there are also key points to remember if you want to quickly revise. For example, ROCE ignores time length, payback ignores the post payback returns. If you remember, all of these points are from advantages, disadvantages, but if you don't have time to revise this chapter quickly, you can just go through these and you'll be able to revise this chapter quickly. This also gives the final checklist before exam, before you go to the examination hall, or before you solve a particular question. You have to read what is being asked in the question. After having finished this chapter, you have to go through this checklist to make sure that you have completed chapter. Now, why don't we read through and see that we've completed the chapter fully? Can you calculate ROCE across both methods, the initial capital cost method and the average investment method? Remember the car example that I gave you, which is number one, you spend 10 lakh on day one, which is the initial capital cost. But number two, you say I will end up getting 4 lakh back. So the average amount that I've invested towards that car is nothing but 10 plus 4, 14 lakh divided by 2, 7 lakhs. That is the second method. Can you calculate payback for both the methods, constant as well as uneven? Constant being the fixed salary method and uneven being the freelancer method. The answer is yes. We just calculated. Know when to add back depreciation. When do you add back depreciation? You add back depreciation when you are given profits and you're supposed to find cash flows. That is when you end up adding back depreciation. Can you identify relevant versus irrelevant cash flows? The answer is yes. If you remember, we had seen these tables on what is the cash flow. Is it when to ignore? Is it a relevant cash flow or an irrelevant cash flow? Is it future? Is it incremental? If it is future and it is incremental, then you consider it. Otherwise, you ignore it because then it is an irrelevant cost. Do you understand the ROCE advantages and disadvantages? The answer is yes. Do you understand the payback advantages and disadvantages? The answer is yes. We already discussed the two. Can you convert the decimals to years and months correctly? Yes, you can. Remember, ACCA will say we are being pessimistic. We don't believe you round it down and you can pay. You have to always round it upwards. Can you discuss which method suits different scenarios? The answer is yes, because in each of these methods, we've mentioned which scenario these can be used. For example, in payback period, you remember payback period is used in the situation where there is a rapidly changing technology or the investment conditions are improving. That is when you end up using payback period. Coming back. Are you now familiar with all the test questions and answers? We have together solved all the questions for this chapter, like we will be solving for all the chapters of this course. So are you familiar with those? The answer is yes. Although I will be insisting that you go to the study hub, solve all the questions for this chapter for additional practice, after which you would have mastered already the chapter 2, which is basic investment appraisal techniques. Stay tuned with me tomorrow. We will be connecting again on the YouTube live for the first 3 demo lectures at 7 p.m. where we will be discussing the advanced investment appraisal techniques, which will involve the time value of money method. I repeat, if you are a student and if you have queries, feel free to reach out to me either in the chat box or directly on WhatsApp. And if you're not a student but you are interested in buying the batch lectures, if you have an exam in March 26 or even beyond, feel free to reach out to the numbers that are given in the description box. I'm here to help you out as your tutor. If you have any queries, please do let me know, and hope you like this lecture. Please let me know any comments, questions that you have, and do like and subscribe to this channel, even if you're not a student, but for content, including revision and strategy videos around ACCA, FM and AFM. Thank you so much and good night. Bye-bye. See you.